It is a cloudy and warm afternoon in the city of Toronto. Welcome to the 13th edition of Portfolio Stewards, Your Guide Through the Storm, on this, the 23rd day of July. My name is Bob Simpson, your host for this series of webinars. Thank you to everybody who's taken the time to join us today and those who are listening to the recording of this webinar. Our guest today is Will Granleese, lead portfolio manager of Antrim Balanced Mortgage Fund out of Vancouver. Will, thank you very much for joining us today. Antrim is Canada's largest residential mortgage investment corporation, having extensive experience in both financial advisory business and mortgage underwriting. Will leads the company in nurturing Antrim's core competencies, creating the firm's strategy, and building a sustainable competitive advantage. Will is an undergrad in finance from Simon Fraser University, then crossed the country for an MBA in finance at Dalhousie, is a financial management advisor, derivatives market specialist, and a chartered investment manager. Will was chosen as one of the top 40 under 40 BC recipients and is the past president of the BC Mortgage Investment Corporation Managers Association. He is a licensed mortgage broker with the Financial Institutions Commission of BC and portfolio manager with the BC Securities Commission. Now, we have recently completed our due diligence process, and we're pleased to announce that Antrim has been selected as our newest premier private debt partner. And the investment that we're going to talk about today will begin to show up shortly in the fixed income / private debt strategies that we run for the Portfolio Stewards clients. So, well, I've got some bad news though, and the bad news is that this is a little bit awkward, that after that lengthy introduction, we really have run out of time. So I'm wondering maybe if you could come back in a couple of weeks and do your presentation then. Does that work for you?
Right. No problem at all.
No problem at all. Anyway, let's get going. I was just joking, of course. So number one, if you want to view one of the recordings, just simply go to portfoliostewards.ca and you'll see, are you looking for a guide through the storm? Click here. We encourage you to ask questions, and you'll see at the bottom of the screen, there's a Q&A. Please, if you have a question, even if you just want to say hi, just type in, go to the chat or the Q&A and type in your question. We'll be glad to answer it at the end of the session. Now, normally we begin this by looking at what we call the storm, the COVID-19 storm that hit financial markets in the spring. And, here's an update on what happened. You'll see the storm really hit us in February and March, and then in April, May, June, and July, we've had positive months, recovering most of the losses that were incurred by financial markets during the storm. And you can see that on this chart that the S&P 500 is about back to break even. This year, the TSX composite is still in negative territory at around negative 6.74%. These numbers all change based on when we get these, but you'll see that the return to date based on the 40-60 portfolio, 50-50 or 60-40 portfolios have recovered very well and are near break even after the significant losses that we encountered in the early part of the year. So now we look at, now we're back to our guest today. And sorry, just jumped ahead there. So let's get us going. So Will, you ready for some rapid fire questions? Here we go.
I'm very excited to start.
Ready to go? Okay, so starting with this is, I did a brief introduction about Antrim here. can you just take a few minutes and just share the Antrim story for today's participants?
Yeah, be happy to. And Bob, appreciate all the kind words and the lengthy introduction, as you say. Everyone here at Antrim. We're just really excited about this new relationship that we started out with your firm, Wealth Stewards, and we're excited that we should be able to, with our product, increase those fixed income returns through our alternative strategy in private mortgages, and also hopefully reduce portfolio volatility extensively with our product that doesn't have a NAV change. We've had the same NAV change in 25 years. So as my introduction, I just want to say we're very excited to be a part of your organization going forward. Antrim, interesting story here with Antrim. My father actually started the business off in 1971. So we've been around now for close to 50 years, the whole time in the mortgage market, in the private mortgage market. And initially, our firm basically operated as a mortgage broker. So we might have yourself, Bob, you might have a couple $100,000 in an RSP, and you might want to diversify that into some private mortgages. So we would go ahead as a mortgage broker and find you some private mortgages and put them in your portfolio by way of a self-directed RSP or something like that. So that was great. Our investors were very happy, but there was a few questions that came up, and a couple of the questions were, I might only be able to afford to buy 2 or 3 mortgages. Am I fully diversified? Right? Typically, we know most stock or bond portfolios, we sort of shoot for that 30 holdings to be completely diversified. So you would need very deep pockets or a very large portfolio to be actually fully diversified to own enough mortgages. Furthermore, when you're buying individual mortgages, you don't have the liquidity that you're looking for, and there's a reinvestment risk. So in the early 1990s, we launched our first pooled product, and it basically was the exact same business we were doing before, except now what we were doing is we were pooling everyone's money together, somewhat similar to a mutual fund trust, let's say, and lending out the pooled funds in mortgages. And so our investors immediately benefited from greater diversification. There was more liquidity that was offered through the fund, and there were just so many advantages that we've seen. So fast forward to today, some 20, 30 years ahead from there, and Antrim is now Canada's largest private residential mortgage lender. We lend from all the way from British Columbia to major centers of Ontario, and we're really proud of the growth that we've had and our history that we had, and looking to build on that history with now a new relationship with your firm. So that's a little bit about us.
Yeah, no, it's awesome. Yeah, you're listening to your story that reminded me of a friend who made an investment into a single residential mortgage a few years ago through a mortgage broker, and then found a business that he wanted to buy. So he made a call and said, "Hey, I need my money." And they said, "Unfortunately, that mortgage is in default and you now own a house." Mm-hmm. So I really see the benefit of the diversified story of working with a firm like Antrim. So, Will, we all, front of our minds, hard to get away from it. You watch the news, it's all about COVID-19. How has COVID-19 affected the mortgage market? Now, you're primarily in the Vancouver market, but you told me you're shifting more into the GTA market. Can you just give us an update on what you see happening in, just from a residential point of view in those two markets?
Right. So like you said, we are now starting to diversify into the Greater Toronto major centers of Ontario, actually. So we'll lend in places like Ottawa and Guelph and London as well. We also, have been lending in Calgary and Edmonton for some time, but in Calgary and Edmonton, the economy is quite slow right now, so there's not a lot of business available, not like there is in Greater Vancouver or Toronto. I tell people when there are major market events, it's very difficult to position yourself or to change your portfolio when the event has started to unfold. So when COVID-19 happened, it just happened with a bang. There wasn't any way for us to rejig our portfolios to deal with the actual event itself. So what we ended up doing is going into COVID-19, fortunately in a very, very strong state. Our mortgage portfolio was paying incredibly well. The listener should know that the maximum that we lend on any property is only 75% of the appraised value. So that's the maximum. But on average, our portfolio had only about a 60% loan to value. So we were in excellent shape, experiencing not very many loan losses, and then sure enough, COVID-19 hit. There was a lot of fear in the market in March, and what we noticed at that time was that the number of sales of houses in, let's say, Toronto and Vancouver sort of dropped off a cliff. It was there was great volume, and everyone was looking forward to the spring market, and then all of a sudden COVID-19 hit, and we were all sheltering in place in our houses, and that was it. Nobody was heading out. So there's a graph on the screen right now that I shared that shows what we were expecting to happen when this COVID-19 hit. And as always, the best predictor of future performance is always past performance. So we look to see what things did in the past. And in the 2008-2009 recession, you saw that housing sales slowed down sort of gradually, hit a bottom, and then came back. But the overall there was that it took about 18 months for the housing market to recover. In the 1981-82 recession, if people can remember that, interest rates spiked all the way up to 19.5%. It was a real liquidity problem. And that was a slightly deeper recession with regards to real estate. But again, in about 18 months, it came back. 1990-92 recession, very similar. So coming into COVID, we were thinking, wow, this is going to be a big event. From a very high level, it's probably going to take us about 18 months to get back to where we were. And what's going to end up happening right off the bat is that we're going to see a dramatic drop in real estate sales, because who wants to show their home right now? And who wants to let people in and have open houses in the middle of COVID-19? So that's what we saw. Dropped off dramatically. But if you want to click over to the next slide that I think you have, which is right there, this is not what we were expecting. So what has happened here over the last 90 days is that we have had a V-shaped recovery with regards to the demand for residential real estate. So in both Greater Toronto and Greater Vancouver, we are now seeing the same number of houses sell today, this month, as they did pre-COVID-19, let's say January and February. This has taken many market participants by surprise. No one was expecting it to bounce back this quickly. And so myself and other portfolio managers in the mortgage space have been talking across the country, and we've come up with a few reasons why we think this is the case. Number one, the massive amount of government stimulus. We are seeing government stimulus and liquidity like we've never seen in our country's history. So the Bank of Canada now engaging in quantitative easing, talking of buying corporate debt, just flooding the market with the cash to keep interest rates low. The CERB, the famous CERB payment that millions of Canadians are benefiting from now, and as well as the federal wage subsidy. So the combination of all those factors really has boosted what would have been a very sluggish economy during this time. That's sort of the baseline that sort of shows in previous recessions, there was liquidity problems. There was not enough money in the market. The banks were not lending. But in this particular recession, that's not the case at all. The banks are more than happy to lend, and interest rates are below historical levels. So that's going on. The final thing I think we can all say from our personal experience is that, although one's home or apartment or townhouse has always been, close to one's heart, we're finding now that it's even more so. Your home is once again your castle, and you spend so much time in your home, and it's so important to you in times of COVID-19. So the very last thing anyone wants to do is lose their home. So everyone is doing everything they can to get into a house right now, or make sure that they don't default on their mortgage payments. So it's absolutely remarkable from a lender standpoint how this particular recession is working out as opposed to others. A lot of people are saying they're looking at this latest stats in Toronto, and they're saying, "Wow, prices are actually going up on residential real estate in the middle of this pandemic. How is that even possible?" And when you think about it, it's from a very basic level of supply and demand, it's very understandable. So what's happening is that you have a number of people that are still uncomfortable in the situation, COVID-19. They're still uncomfortable having open houses. They don't want to move right now. So what you're seeing is that the number of houses that are available for sale in Greater Toronto and Greater Vancouver is lower than it was this time last year. Okay, so there's less houses available. But at the same time, we just talked about many reasons why home and shelter is more valuable, and so there's lots of demand going on for housing. So it's a very basic supply and demand imbalance, in which case right now we're seeing multiple offer scenarios again on houses, and we're seeing a very hot market with actual rising prices in many areas of Canada. Our office's opinion on this is that this is a temporary situation. As we run through the rest of the summer, and as we run into the fall, you will notice that more and more people will become comfortable with open houses, and people will structurally need to move for work or school or what have you. And you will see the supply of houses on the market increase as we roll into the summer months. So because of that, we do expect prices to moderate somewhat. We do not expect the gains in prices that we've seen over the last couple of months to continue for the rest of the year. So the good news, I think, for everyone on the call is that what we've seen over the last 90 days is that there's a tremendous amount of strength in the real estate market, and the concerns that were there initially about some potential large price drops, it's very, very unlikely at this point in time that we're going to see that happening over the next year.
Yeah, perfect. And that's great summation. Thanks, Will. And, the one thing I know is a house, I think 5 houses up the street from us went up for sale and was gone in 24 hours. Mm-hmm. So the market, this dog has been bubbling. And I think, again, a supply-demand situation. Now I'm going to change, my third question, I'm going to change it a little bit for you. And my original question was, who's an ideal investor for your fund? But before you talk about that, could you, who do you lend to? Can you give us a profile, the kind of people that you're lending to? Because isn't it just as easy for people to go to the bank and get a mortgage?
Right. No, that's an excellent question. So many people ask that question. Who we lend to is about 2% of the Canadian mortgage population who find it difficult to obtain mortgage financing with either a bank or a credit union. And the vast majority of those people, it's because they're self-employed. They are self-employed, either they're newly self-employed and they don't have a record of employment for the last 3 years, or their income is volatile from year to year, or they may own a company that is held by a holdco, and they split income with their partners, and regardless of all these scenarios, at the end of the day, the amount of income that they're showing on their T4 and notice of assessment is not really representative of how much money they're actually earning after they write off. So that's the majority of our investor base. We also do probably 10% of our lending to new Canadians. Most listeners here today will probably know that currently the federal government is going gung-ho, full speed ahead with immigration into the country. In the Greater Toronto area alone, last year there was over 100,000 new immigrants that moved into that Greater Toronto area. Now, you can imagine if you are a new immigrant in Canada and you don't have credit in Canada and you don't have a job yet in Canada, but you know where you've come from and your values are that you want to own your own home or you want to own land or something like that. You can understand why these people would want to buy real estate and would want a mortgage and would be willing to pay a slightly higher interest rate to people like ourselves, a non-bank lender, just so they can establish themselves in the country. Those are the two main groups. As far as ages go, we're looking at people who are between the ages of 40 and about 65. That is typically the age range for our people. Our people have very good credit, so they pay their bills, but they just can't prove the income the way a normal salaried employee could. So what we do is we go ahead and we supply these people with mortgages on a one-year term that are fully repayable at any time without any prepayment charges. And typically they utilize our mortgages for about 3 years until they qualify at the bank, and then they go back to the bank. So it's a relatively established, relatively high net worth individual that due to how they structure their income or their net assets do not fit the specific matrix of the bank, and they're just looking for a relatively short-term solution to purchase residential real estate until they qualify for major banks.
Right. So, I'll jump off the second part of that question and we'll go directly to the next one, which is, people who are lending to individual mortgages and that, they have an idea of what kind of returns they're getting. You've been around for a long time. Can you address the historic returns of Antrim? Plus, I think you made a comment. I thought I heard you say that you've never had a negative month. Is that, or did I mishear that?
No, that's right. So we've been managing pooled funds, like we said at the beginning of the presentation, since the early 90s, 1991. And during that period, there's a graph on the screen now. During that period, we haven't had one single calendar year in which case we've had a negative rate of return. Now, when you think about some other things that I've said as well, with regards to the security that we offer, you can see how this is possible. So I said that we lend to a maximum of 75% of the value of any property. But in the portfolio over time, we typically have a maximum or a portfolio average of about 60% of the value of any property, which means that there is a 40% down payment cushion on average protecting all of our mortgages. So you can just imagine how bad a real estate crash would have to be in order for us to take sizable losses to actually bring Antrim into a negative position. So it hasn't happened, like you said. Over the past 25 years, we've averaged a rate of return of around 8.5%. However, we all must realize that in the past, interest rates were higher. You can remember in the early 1990s, the prime rate was closer to 5.5–6%. So we are in a slightly different interest rate environment right now. But the key with Antrim is that you're always going to earn a nice risk premium. So if we had a graph that we were showing right now, let's say as Government of Canada 2-year bonds versus Antrim, you would see that Antrim follows the ebbs and flows with what let's say the Government of Canada is paying, but always let's say 3 times or 4% higher rate at all times. So it's a great investment for those fixed income investors that are having a hard time with the volatility in the stock market. Maybe people who are in the later stages of the investor life cycle, people coming closer to retirement, or just conservative investors that say, you know what, I don't want to handle all the volatility in the stock market, but at the same point in time, I'm not willing to give my money to the bank for a 1% rate of return, right? There has to be something in between. And that's what we offer. So we offer that tremendous amount of security, long track record with rates of return in this market, let's say, in the 6 to 7% range. And what we like to say is with Antrim, we're constantly, we're hitting base hits. We never swing for a home run. You're never going to get a 20% rate of return with Antrim, but what you're going to get is that consistent, 6.5%, 7% on an annual basis. And as many of our investors have been with us for 10, 20, 30 years, you'll just see that miracle of compounding really shows itself. And it's remarkable what type of gains can be achieved over the long term.
Yep. So can you just touch, Will, on two things? One is what you see the risks are for investors in this investment, and how liquid is it? How quickly can you get your money, and how do you get paid on the investment?
Okay. So the risk of the investment, the good thing about Antrim is that it's a very simple, straightforward investment. I might be a derivative market specialist, but thank goodness we don't have to use derivatives on a day-to-day basis, or we have to explain some kind of option strategy here. We are basically lending to Canadians in a pooled mortgage product. We earn interest from those mortgages, and that's pretty much that simple. So the real concern from an investor would be a market turndown with regards to real estate prices. So we've seen in previous graphs there, we've seen how most of the time interest rates or a banking crisis has caused some kind of drop in real estate prices. And although we haven't seen anything, any large price drops in the last, let's say, 10 years, of course, there's always the possibility that something like that would happen. And it just so that everyone on the call knows, we have a balance of first and second mortgages in this portfolio. So 75 to 80% of our mortgages are first mortgages, and the balance there being second mortgages. So we always overweight on the safety side, and we're always cautiously, reminded of our fiduciary duty to make sure that the portfolio is as safe as possible. So that is the main realistic risk to the portfolio would be, an economic issue, in which case we would have to, let's say, foreclose on more properties. Now, the interesting thing here is just because we have a foreclosure, it's not the end of the world. Because we have such a large down payment in our mortgages, if we have to foreclose on a property and sell it, most of the time we can go ahead and do that and collect all our accrued interest and go about our business. From time to time, we will foreclose on a property, and we will not be able to sell that property at current market prices. In which case, if we want to, it's our option then to own that property, to rent it out, and wait till the market conditions become better. In which case, we can sell at that time. And there was a number of years ago where we experienced an event like that in the Okanagan region of British Columbia. It's a very slow market, and we had a number of foreclosures. And what we did is we decided to sell half of the units at the current market price. The other half of the units we decided to rent out for 18 months, which we did. We collected rents, earned a modest rate of return on that, and then sold into that market. And sure enough, by that time, the market had recovered, and it was a successful strategy for us. So that's it. On a practical basis, of course, liquidity comes up with our investment. I think, and that was the second question you asked, it's important to recognize the difference between Antrim and, let's say, publicly listed mortgage firms on, let's say, the Toronto Stock Exchange. So when you're dealing with a mortgage corp on the Toronto Stock Exchange, the buying and selling is all happening between third parties buying and selling from each other. And you have the potential of what we've seen over the last number of years of wild fluctuations in value just because there's not much of a market for these products. For example, someone like your firm, Bob, you may want to redeem a number of clients' portfolios, and there may be no buyers that day. And there may be nothing wrong with the underlying investment itself, but just because there's not enough buyers, the stock price falls till you can catch a bid. So things like that don't happen with Antrim because we actually maintain the treasury ourselves. In addition to a cash position and all the mortgages, we maintain a $100 million line of credit that's been syndicated through the Royal Bank of Canada and the Toronto Dominion Bank. And they backstop us just to make sure that we always have funds available for redemptions. Now, in our offering documents, it does note that although it's never happened before, should there be more redemption requests than we actually have cash available, management at Antrim could restrict redemptions in some cases and maybe make investors have to wait 90 days. Again, it's never happened, but we do put that into our offering documents just in case there was a scenario in the future that something like that happened. In practical purposes, for the last 25 years, we have investors have been able to buy and sell Antrim on a daily basis. And with Antrim, you start earning interest the day you actually invest in our product. So if you buy, let's say, halfway through a quarter, then you go ahead and start earning interest there. You don't have to wait till the ex-dividend date to actually start earning interest. So that's how it works there.
Right, so kind of like a daily interest account that's yielding somewhere around 7%. You were saying the two numbers that we talked about when we did the due diligence calls. One was how many mortgages are in the pool right now?
Right now, we're hovering around 1,700 mortgages, yep, which obviously is a lot more than you need to be diversified. But the key there with Antrim is that none of those mortgages come anywhere near 1% of the mortgage portfolio. So we can have a handful of mortgages go into foreclosure or go into arrears without affecting the overall portfolio, which is what you're looking for in a mortgage product.
Right. So what we do at Wealth Stewards is Antrim is an investment that we look for this kind of profile where we see the nice straight line of performance. When we're doing the fixed income, lower risk investments, we really do not want volatility. We're looking for safety of capital first. We're looking for return second. And we like this kind of profile. But we take something like Antrim, we combine it with some other private debt offerings that have similar profiles just to further diversify, to further pad the risk, pad the safety factors of the portfolio. So I think that's good, but just because the intro went on so long, Will, we're running near the end. If anybody has, thanks for the presentation. Looking for questions, we can keep the lines open for a few minutes.
I see one there, Bob. We have a question here from Gerald asking, is the investment RSP eligible? And it certainly is. We have many thousands of RSPs, TFSAs, RIF accounts. It certainly is RSP eligible.
Yep, great question. Thank you. If you do have questions, please talk to your Wealth Stewards advisor, and we'd be glad to give you whatever information you need so that you understand this as best you can, so you understand whether it's suitable for you. But Will, thanks very much for the call today. We appreciate your time and facts that you shared with us, and maybe we'll have you back for a future call.
Yeah, no, I really appreciate the opportunity. Like I said before, we're really excited to be partnering with your firm and everyone on the call and all your clients that start having Antrim added to their portfolios are really going to benefit from that low volatility and hopefully we can earn them some interest income during these difficult times.
Yeah, no, it's awesome. Okay, well, thanks everybody for joining us today. We appreciate that you have joined us. And the next session is 2 weeks today at 3 o'clock, and we'll send out details of that meeting in a couple of weeks so that you can be prepared for that. But thanks so much, Will, and thanks to everybody for joining us today.